The credit score was not invented to help you, it was invented to sort you. And the system doing the sorting was built by people who had a very specific idea of who deserved access to money and who did not. Before credit scores existed, lending decisions were made by local bank managers who knew their customers personally. That system had serious problems. It was riddled with racial bias, personal favoritism, and inconsistency. A black family in 1950s America could be denied a loan by a bank manager simply because of who they were, regardless of their financial situation. So in 1956, engineer Bill Fair and mathematician Earl Isaac created a mathematical scoring model, the FICO score. The idea was to remove human bias from lending by replacing it with data. On paper, that sounds like progress. In practice, the data they chose to measure locked in a different kind of inequality. Here's how the FICO score works. It measures 5 things: payment history, amounts owed, length of credit history, new credit, and credit mix. Notice what is not on that list: your income, your savings, your assets, your actual ability to repay a debt. None of that matters to your credit score. What matters is your relationship with debt. Specifically, how long you have been borrowing money and how reliably you have paid it back. If you have never needed to borrow money, if you grew up in a household that paid cash for everything and avoided debt on principle, your credit score is low. Not because you are a financial risk, because you have not participated in the debt system long enough. This creates a direct structural disadvantage for people without generational wealth. Wealthy families can add their children as authorized users on credit cards early, building their score from a young age. They can co-sign loans. They can absorb the cost of a missed payment without it destroying their financial life. Poor families cannot do any of that. A single missed payment when you are living paycheck to paycheck can drop your score by 100 points. That drop raises your interest rates. Higher interest rates cost you more money. Less money means more financial pressure. More pressure means more missed payments. The cycle is self-reinforcing. And here is the part that makes this system particularly effective at what it actually does. A low credit score does not just affect your ability to get a loan. In the United States, it affects whether you can rent an apartment, what you pay for car insurance, and in some states, whether you can get certain jobs. Your credit score has become a proxy for your entire character, built on a formula that was never designed to measure character at all. The people who designed the FICO system did not set out to oppress anyone. But the system they built rewards those who already have access to credit and punishes those who do not. Wealth begets credit. Credit begets more wealth. And the gap between the two groups widens every year by mathematical design. Your credit score is not a measure of how responsible you are. It is a measure of how profitable you are to lenders. Those are not the same thing, they never were.